Tuesday, January 11th, 2022, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at some very long-term charts and to look at whether the Federal Reserve is engineer a protracted blow-off top. Before I start though, I'd like to talk a little bit about the fact that on this channel, I'm not giving financial advice. This is just my opinion of what markets and economies could do. And I'll go back to my time in the city of London. I started out in Geneva, Switzerland. I worked for a small private bank from 1989 to 1992. I worked mostly, I started out in the back office. I did learn quite a bit from the front office how to deal in bonds, stocks, derivatives, foreign exchange. And then I moved to London in 1992. And eventually in 1993, I did what was called at the time my registered reps or representatives. And you had to do a course. Usually the firm you work for sent you to a course. It was over a week or so. And then you took an exam. It's like similar to the Series 7 in the US. And then you passed the exam. If you didn't pass, you might have to take it again. And you became eligible to speak to clients in the front office and give them your opinion, even give them advice on what to do. That was the SFA. The SFA eventually became the FSA, and now it's the FCA. And I would say that even when I was a registered representative, I had all my qualifications, and towards the end of my career in the city, there was a point under the FCA where you had to do an exam every year. Prior to that, there wasn't. But even then, with my clients, yes, I was giving them my opinion. I wasn't the kind of salesperson or broker that kept calling and telling them, do this because this is what is gonna happen. Sometimes I would, but it was more a matter of telling them what I thought. And most of my clients, of course, well, all of them were institutional clients. They had a very good idea of things as well, but they wanted to know another opinion. So that's what I'm trying to say here. This is just an opinion. And why a protracted blow-off top, or if you want to call it a crack-up boom? Well, during Weimar Germany, the hyperinflation, when it started, it only lasted about 12 to 18 months. And yes, I've been saying as well that it wouldn't last that long, but sometimes you need to change your opinions because back then there was no central bank, no Federal Reserve when this happened, or there was, but the Federal Reserve was not really involved in Germany. The Reichsbank didn't have that as many tools. We're still under kind of a sound money system for the whole world. So that crack-up boom really took off in the summer of 22, and by 1923, everything imploded. But now, as we've seen since 1913, especially for US markets, booms and busts are getting bigger and bigger. And if you look at the Dow Gold ratio as well, they've been able to extend things much further because they've started doing QE. They've got rates at zero, near zero. They could go next to negative, I would say. And that's why, by protracted, I mean, I think they could keep this going for a long time. For example, I've looked at this chart before, back in around 2017, 2018 on this channel. It's a chart of the Dow Jones Industrial Average going back to the 1920s, and it's a logarithmic chart. And I was saying back then that there would be big resistance around 28,000 in the Dow. That's the level I had for like 2018. And yes, we never reached that level. We were around 27,000. Because you look at that trend line, it's a very important trend line. Going back to the top in 1929, it was around 380 something, the Dow top then. After the crash in 2020, we've actually gone above that line. And that's why I have a feeling that we could see continued strength in the stock market. Yes, we could have corrections like we've seen recently in the NASDAQ especially. But this is a very interesting chart. It tells me that maybe we are under a crack-up boom. And the other thing that I was thinking about this morning when Billy and I were going for a walk, if you go back to 1966, for example, there was a top in the stock market back then. And then it wasn't until 1980 really that the stock market bottomed in the first quarter. So that took about 14 years. And then you had 7 years of a market move higher. And then in 1987, of course, we had the crash of 87. It was similar to the crash in 2020, I would say. And I know the Fed and central banks have been intervening, but we need to look at it in terms of the chart and what happened. So the Fed intervened, and then you had another bull market that lasted until 2000, which was another 13 years. So very, very similar to 66 and 80, 13, 14 years. And then we had a correction, of course. Bottom sometime in 2002, but I'm looking top to top here. So from 2000, there's another correction, of course, into 2002, but then in 2007 again, the stock market topped. It's another 7, 8 years. And then, yes, there was the crash of 08, 09. But if you add, let's say, 13 years to 2007, you get 2020. And we had another top in 2020, in beginning of 2020. And then we had a crash in March of 2020. So it looks like we've got like a 7 or 14, 13, 7, 13, 7, 13 kind of cycle. So if you do 2020 plus 7, you get 2027. So what I'm trying to say here, we could see continued stock market strength for the next 5 years. Where could the Dow go? Well, we could go to 50, 60, 70,000 easily. And how though would that how would that justify a lot higher commodity prices? And I agree, we are in a super cycle in commodities, like Goldman Sachs. I think commodities are heavily undervalued versus the stock market. So how could that be that the Dow could go to 50, 60, 70,000 and commodities do really well? Well, I think it's because it's a crack-up boom or a blow-off top. And what this means is it's not a really good signal. It's a signal that the dollar is dying because you're getting so little for the dollar in terms of stocks, commodities, everything else. And how are they going to keep this going? Well, more QE, more maybe even negative rates. What about the CPI? CPI is going up. Well, I think they'll find a way to tinker with that and make it, even the PCE, and make it look very low compared to real life. And I think it's going to hurt, of course, the general public a lot. But I think we're going to see governments, not just in the US, but everywhere, try to help out the public. And it's going to make things even worse, as I spoke about yesterday. So even if the dollar index were to stay where it is around right now, around 96, and this were to happen, or even if it goes back to 100, does it mean that the dollar is a place to be? Well, I would compare the dollar index, for example, to a bag of rotten apples, and the dollar is the least rotten apple right now. But even the dollar index has a cycle, and I've looked through this many times. I've done videos about it, and it seems to have like a 7 to 9 year cycle from bottom to top and from top to bottom. And if you look at this chart here, I have the last big top in the dollar index in the first quarter of 2017. So if you add, let's say, the average time for cycles in the dollar index, this leg down could take 7 to 9 years. So you add, let's say, 9 to 2017, you get 2026. It could be 2025. It could be even a little longer. These cycles are not set in stone. You can do an average. So this makes sense to me that we could see, yes, a blow-off top in the stock market, a super cycle in commodities, and a dollar weakening versus other fiat currencies. But I would say other fiat currencies is not going to be the place to be. You will want to be in hard assets. Yes, the Dow will do well, but here I'll move to a tweet I saw yesterday by Grady. He's a Swedish technical analyst, and I retweeted it on my Twitter account, and this is what he said. CRB, which is a basket of commodities, versus the Dow. My FBO call made back in March 2020 was confirmed after 3 quarters. It now has 8 white-green candles in a row from the low. And he says, one of the most important big picture charts right now, general equities is shaky right now. This chart is the opportunity of this decade. So basically he's saying here how commodities are undervalued versus stock. But at the same time, it looks like stocks could go even higher, which sounds crazy. But how could this happen here, that we could see a huge opportunity in commodities, precious metals, general commodities, base metals, all commodities, and the stock market's still going up? Well, it would mean that the commodities would go up even faster in terms of percentage terms than the stock market. And it's possible. And that's why I'm saying, has the Fed engineered a crack-up boom? Maybe. But one thing's for sure, I'm going to be keep my exposure to precious metals and commodities. I will probably make a video of how maybe one can be exposed to commodities through, I guess, ETFs or stocks. And of course, that's not going to be advice. That's something that I'm looking for myself, that you can think about and maybe do some work yourself. But I found this really interesting. And the last piece of the puzzle, I would say, is the bond market. Yes, interest rates have risen significantly this year already, from like 150 to 180. I think it could rise more. We could go into the 2%, 2.25% maybe. But I think by that time, the Fed is going to shift. They might raise rates like Jamie Dimon is saying, but I think something's going to give, and they're going to shift policy. They're going to become accommodative again. We're going to see, yeah, that's what I think. And I've looked at this longer term chart, quarterly 10-year future chart. This is the price of bonds. This is not yields. And this is going back to the early 80s when the bull market in bonds started. And as you can see here, we're still in an uptrend. And yes, since the beginning of this year, As you can see, there's been a little blip lower. But in the bigger scheme of things, it's not a huge move. And we could continue, as this is a quarterly chart, we could continue seeing bonds go lower and yields go higher in the next few months. And this is going to be the key line to hold on to. So am I saying interest rates are going to stay low? Yes, I think they might. Not because there isn't any inflation, but because there is a lot of inflation, and the Federal Reserve is using this inflation. And by inflation, I always mean the creation of easy currency and credit. Hate to use the word money or reserves as well. Yes, I know there is there's a public market for money where the general public uses money. It's called currency, created by the commercial banks. But if it wasn't for the Federal Reserve creating all these reserves out of thin air that they put onto their balance sheet to buy assets, the commercial banks wouldn't be able to be creating all the currency and credit. And the flip side of this will be a currency that is going to lose a lot of its value, especially versus real things, commodities, and also financial assets. But I think we're going to come to a point where we could see the Dow, let's say 60,000, but then gold will be like at 30,000, and other commodities, I don't know, oil will be at $250 or something. So if you do the ratio 60 to 20, 3 to 1. So that's how I see things right now. I could be completely wrong, but I think that is one of the possibilities. Just looking at the charts, how the world would look in the next 5 years in a place like this, I don't know. And it's my opinion. I think it's up to each one of you to do your own homework, to look at the charts and to look at, to look at what's going on out there in terms of monetary policy as well. I noticed that Powell today, he's going to be at a hearing for his confirmation. And according to Bloomberg, Fed's Powell vows to prevent inflation from becoming entrenched. So that's what he's going to be talking about today. Well, he's going to be, I'm sure he's going to be trying to placate the people in the Senate. It is his nomination hearing. It's in front of the Senate Banking Committee. So there you go. With that, let's quickly look at where the markets are this morning. It's 9:05 a.m. London time. Yesterday, we saw NASDAQ under a lot of pressure early in the day, and then it rebounded and finished even up on the day. But that's all short-term noise. And what I talked about earlier in this video doesn't mean that I think stock markets are going to go up right now. They could have a big correction. I'm talking more like in the next 5 years, as I said. So I noticed though that gold and silver did very well yesterday, while the stock markets were losing like 1.5% to 2%. Silver was actually slightly up. Gold was mostly down most of the day, but finished above 1800. So encouraging day for precious metals. I noticed Bitcoin traded below 40,000, but then it rebounded. Right now it's at 42,000 for those of you who look at cryptocurrencies. So right now, yeah, we've got spot gold at 1808.50. It's up about $7. The range has been 1810 to 1800. Silver's up 16 cents. So it's outperforming gold this morning. We're at 22.60, sorry. Range has been 22.69 to 22.43. I still think that 23 level is important, not because it's 23 a round number, but it's an important retracement level from the low in March 2020 to the high last year, just about around 30. The Dow future is up 50. The NASDAQ is up 15 points. S&P futures up 6. The FTSE is up 22 points. To the currencies, we've got sterling continue to rebound. Yes, it was very weak in the first half of December, but now it looks like we're in an upward leg. It's up 0.25%, just above 136. The euro's up about a quarter as well at 113.50. The dollar is up slightly versus the yen at 115.37. Dollars unchanged versus the yuan, 637.87. Aussie dollar up 0.2% at 71.85. The dollar's down almost 1/3% versus the Canadian dollar, 126.42. And the Kiwi dollar is up 0.2 at 67.73. Quick look at the commodities this morning. WTI crude is up 1.25%, 78.70. High-grade copper is up 2/3% at 438. And to finish off, look at the 10-year yield. Where are we? 10-year yield has backed down a little bit. We're down almost 3 basis points. We're at 1.75%. And yes, I think we got up to 181 yesterday. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.